I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Ross, real estate investing is something we really have not talked about on the show, but a listener asked, can Ross discuss investing in real estate and whether the winter of 2017 is a good time to start?
The winter of 2017, a good time to start. Well, what I would have told your listener probably is the best time to start may have been last November, when he could have or she could have secured an interest rate of 1.99% for 5 years on an investment property, and that may have been a little bit of a different story for them. Investing in real estate, what I'm going to frame this conversation for, Jim, will be strictly owning residential real estate for the purposes of renting it out to a tenant. A noble investment strategy for most people. It is a great way that we're able to allow our housing stock to be accessed by people who are not in a position to buy the real estate. I'm not an advocator of speculation. So if you're to buy real estate on the premise of flipping it, which, in all fairness, it's a very easy process to do when you know where the market trends are going in any individual market. It is still not something I would recommend for anyone, because there is a legal requirement to pay capital gains. And even if you were able to secure a 15% gain over a one year period of time, the full cost of doing that is not going to make it work. You have to do it really on these pre-sale condominiums where you purchase years in advance of the building being built. You then have to hope that the housing market will continue on the pace that it's on, or you're buying at the right time of the trading cycle so that you know that that's going to happen going forward. And then you've got to hope that there's no bumps in the road that can mess that speculative move up. And then you sell the pre-sale prior to closing so that you have an opportunity to possibly not be held accountable for some of the tax you should be. I would certainly never recommend that. It's illegal, and but I do know that people have done it over the years, and hopefully the government will be cracking down on that. So in terms of investing in real estate, we look at these issues as a long-term buy and hold. So you should not get into investing in real estate unless you're getting into the market with a minimum 15-year plan. So if you're 60 and you're thinking about buying a rental property and holding it for 10 years, that really is not a good strategy, because the market cycles in a way that puts a lot of risk when you're only looking at 10 years. 15 years, you're probably okay. Our preferred strategy when it comes to real estate is that you never actually sell the property. You actually purchase the real estate in a manner that allows your mortgage to be paid off as quickly as possible. You then can use that to leverage again to acquire more properties if you so want, or you can just start pulling an income out of the property because it's now sitting there with only property taxes and maintenance and renovation as a required yearly cost in terms of owning it. Once the mortgage is paid off, that means. It is an absolute, I really do not know of a retirement vehicle that is as good as real estate, residential real estate that you're renting out to families. If you qualify your tenants in the proper way, there is virtually no risk in this decision. If you have a plan to pay off your mortgage, or you know what the mortgage cost is, the interest rate costs, from the day you acquire the home till the day the mortgage will no longer exist, you can make some really outstanding, long-term financial investments that way. I really do not know of another way where you can invest with the kind of security that rental real estate will provide you. Now, that being said, I know there's a lot of real estate investment networks, real estate investment speakers that come around. Key Spire, I think, is one of them. The guys, the Property Brothers or somebody like that's on them, where they charge you just ridiculous sums for to participate in these seminars or to become members of their networks, or they just continue to try to upsell you. Now, they're doing that because they don't know how the market functions, and they can't sit back and tell you what's going to happen with your investment, so that the advice they're giving you, they could charge you enough for it up front. They have to use these strategies where they go about nickel and diming you over a long period of time, inviting you to their seminars and whatnot, to try to justify them earning an income. We charge no different for investor members at the Wealthy Homeowner than regular homeowner investors. So there really is, it's a negligible cost, and because of the structure that it's done, those fees are all refunded. But in terms of buying an investment property, you simply buy it the same way that you're going to buy a home. You buy it no differently. We view every single one of homeowner in Canada as a tenant. So you may own the property, and you may be a tenant of a property that you own. That's how we look at all real estate investments. One of the problems that a homeowner has versus living in the home that they own versus renting out a home that they own is that at a certain given period of time, when the mortgage is paid off, people stop viewing the home as an investment that you should be expecting a return. When you own the home and you rent it out to someone else, you always expect a return, because if you don't, the money's coming out of your pocket to pay for any expenses. The reason why the TFSA has been so good is because that we can take a ordinary homeowner's home that they live in themselves, where they're the tenant, and they can put the TFSA addition onto their home, and they can mitigate some of the investment loss that they would have had should they have rented the property to someone else other than themselves. Timing the market in terms of rental real estate is probably beyond the scope of most of your listeners here. It's certainly beyond the scope of all of these networks and seminars that are being offered, or they would say that they time the market and that's how they do it. They're not able to do that. We would never recommend timing the market to get into a rental real estate investment. The location that you're going to buy in is very important. The type of property that you're going to buy is very important. The market conditions that exist long term in where you're going to buy the property is very important. The financial ownership rules that this property will be held under are very important. And it's very straightforward. It is a very black and white decision, because there is no risk when you approach it in the proper way. So should you invest into it? Yes, there are locations in Canada today in 2017 that you could buy property. Do you live in that province? Are you going to be willing to be the property management? Are you going to have to hire some outside property managers? That's a service my firm doesn't offer. We don't do property management because we believe as an investment you should be doing it yourself. There are tax advantages to doing it yourself that you do not get when you pay someone. We also want to remain unbiased, and we don't want to be generating any profits from what we're doing, from the advice that we're giving you. So you've got to take all those things into consideration. I'll tell the listener if they're interested in doing something like that, they certainly should apply for a membership in the Wealthy Homeowner, and they can get all those sort of questions answered, Jim.
We'll have more with Ross Kay right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with Ross Kay. Ross, we're getting conflicting reports from people looking to refinance or renew their mortgages under the new mortgage rules. There seems to be a new strategy being recommended by some mortgage brokers about paying to get mortgage default insurance in order for the banks to offer a lower mortgage rate. What's your thought on that concept?
Yeah, I've heard that recommended by, we've had a couple people call in, and that has been an actual recommendation, Jim. So I know that that's going on. I have watched it, a couple of news articles stating that way, and I can understand how it would be confusing for listeners. What your listeners need to understand is this. You're going to pay mortgage insurance if you have less than about 65% loan to value. So if you have a loan to value that is greater than 65%, one way or another, you're probably going to be paying mortgage default insurance. That is done a couple of ways. You either just pay for it up front honestly, and the people are honest with you, and they charge it to you, and they add these things to your mortgage. They roll it into the mortgage with the inference that, okay, well, we're going to roll it in, so it really is not going to impact your payment very, very little. Or they bury it, whereby they charge you a higher interest rate for the mortgage, which the only purpose of that higher interest rate is so that the lender can go out and purchase the insurance for you anyways. It's called portfolio insurance. What your listeners need to understand is with these new mortgage rules coming in, their own properties, refinancing, you need to sit down and you need to look at your mortgage situation as a whole package. Because you have to understand, if someone's giving you advice that you should pay mortgage insurance in order to get a lower interest rate on the mortgage, there is a simple financial calculation that needs to be done to know what the true cost of that strategy is. Are you saving money, or is it costing you money? Now, the problem with most of these strategies is they look at them at a very short-term window. In other words, they'll look at it, over the course of the next 5 years, it means you're going to pay you're going to save this much interest, but the mortgage default insurance costs this much, so there is a net cost or savings of $1,000 or $2,000, whatever the case would be. We don't look at it that way. We know that your listeners, in general, are going to roll those mortgage default fees into their mortgage. And that means the very last mortgage dollar that will be paid off will actually be mortgage default insurance cost. It's the very last dollar that will be paid off because it's the last dollar you're adding to your mortgage, the last expense that is included in your mortgage. That last dollar accumulates the greatest amount of interest. If you have a remaining 17 years in your amortization, that mortgage insurance, not only do you pay for the cost of the insurance, but also the interest that accrues over 17 years before you finally pay it off. This is one of the misnomers about real estate commission. what your listener should understand is this with commission. There is a built-in value for real estate commissions in the selling price of properties. That is so well built in that you can't go to a bank and get the cash to pay that commission off. The only way the bank will agree to pay that commission for you via the purchase or sale of real estate is to include it in the contract, the contracted price, which means it will be included in any mortgage money that's outstanding. So your commissions are already the very last dollar that you pay off of a mortgage. This is why we tell people, you can't just look at the $28,000 you may pay in commission that the real estate agent is going to charge you today as for a home that you're buying for the sake of the argument. Because remember, home buyers pay the commission, not the home seller. It is a myth that real estate has used for 40 years that, oh, don't worry, buyer, you don't pay the commission, the seller does. No. If there was no commission, the buyer would be buying the house for less money. It is 100% fact that every home that is sold in Canada today with a real estate agent, the buyer pays 100% of all commissions. Those commissions are rolled into the mortgage, and they're amortized generally, if you're a first-time buyer, for 25 years. So a $28,000 commission expense could end up costing you $45,000 by the time you finally paid it off. This is some of the real estate math that homeowners don't understand, home buyers don't understand. Mortgage default insurance is just another example. You need to look at the entire package and how it's going to cost you over the length of your mortgage. You need to understand if the person that is giving you this strategy is doing it for their own personal gain, i.e., oh, we're going to book a higher mortgage. I'm going to make more commission because I'm a mortgage broker. They're going to roll your default insurance in, and maybe I'm going to be rewarded by that mortgage default insurance being paid commission on. The bank may want to do it because they don't want to give you as much mortgage discount as your neighboring bank would give you. So they want to roll it in to the default insurance instead. They want to do a bait and switch, basically, is what's going on. So these new mortgage rules that are coming into place are really no different than the rules that have always been in place because it simply costs you money. How much money is it going to cost? How is it going to be paid for? What is the net cost down the road? Is it going to be paid for with after-tax dollars or pre-tax dollars? Is it going to be included in the mortgage? Is there going to be commission on it? Are there going to be taxes on it? Is it going to be amortized over 10, 20, 25 years? All of those things must be included when someone discusses, should I pay mortgage default insurance in order to get a lower interest rate? I would encourage all of your listeners to Google right now and look at all the articles that have been written over the last 2 months about this topic and find one, because it doesn't exist, where what I've just told you is relayed. All of the articles that are written from a stakeholder's viewpoint. They're written in order for someone else to make money off of a decision that you're going to make. You need to take things in your own hands. You need to sit down and understand, is this decision going to really cost me the $1,000 they tell me it is? Or is it actually going to cost me $15,000 by the time I'm done? Those are the decisions that you need to make. Those are the decisions that makes you either a wealthy homeowner or a poor homeowner. We know, statistics show, the vast majority of people who have owned homes for 25 years are what's called house rich but poor in terms of many living in poverty. Their pensions are not enough to make them survive. They have to go with a reverse mortgage. A wealthy homeowner makes a decision that is in their best interest. If that is going to cost them $15,000 extra dollars, they're not going to make the decision. They're not going to listen to someone who tells them, oh, it doesn't really cost you anything, or, oh, it only costs you $1,000. they're going to sit down and do the math. And if they don't want to do it, they can have someone else do the math for them. A very, very simple question that really has a very, very simple answer, because the answer is rooted in home ownership math. The answer is a black and white answer. You just have to add all the variables into your calculation so that you're sure the decision that you're making in terms of rolling that mortgage insurance into the mortgage, or paying a higher interest rate instead of paying the mortgage default insurance, all of those things are looked at from your viewpoint as an owner, not from the viewpoint of someone else who's looking to make a buck off you.
We'll have more with Ross Kay right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, we're hearing talk about new listings to sales ratios being used to define buyers and sellers markets. You've warned our listeners in the past about this, but can you remind us what your opinion is about using these ratios?
Okay. So, yeah. These ratios, I know that they're pulling up ahead, and I know that there's charts that are out there showing a correlation that seems unbelievable. In other words, it looks like it's identical. There is a difference between correlation and causation. Causation means that something is causing the outcome to occur. New listings to sales ratio, or months of inventory, which is another calculation, they correlate to house price changes. They are not the cause of house price change. There is no documentation anywhere in North America that shows a causation between new listings and sales. It does not exist. CMHC does not have it. No bank economist has it. The Canadian Real Estate Association or the National Association of Realtors in the United States do not have it because it does not exist. New listings are, well, why? So why? I'm jumping ahead of myself here. Why? Why does it not exist? The way new listings are counted, and sales for that matter, changes from location to location across Canada or North America. Not only that, it changes from year to year. Let me explain this to your listeners. In 2012, the new listings to sales ratio did not include, issued by the Canadian Real Estate Association, which is the only new listings to sales ratio that any economist in Canada has access to. They have, or blogger, or real estate analysis, or so-called expert. That is the only one that they have access to. In 2012, the Canadian Real Estate Association did not count mere postings, which is a type of listing, which is actually called for sale by owner. They were not counted in the new listings counts. They weren't included in the sales counts either. In 2017, they're fully counted. Virtually all for sale by owners now are counted in new listing counts and sales counts in Canada. If that was true then, in other words, we're now counting something totally different, the new sales to listings ratio would have reflected that change. It would have showed that the ratio moved greatly because simply of that one change alone. We're now counting for sale by owners. We weren't counting them 5 years ago. That never changed. Their ratios, Their definition of a buyer's market and a seller's market, which they use, which is we laugh at, they use the new listings to sales ratio to attempt to determine, hasn't changed. Yet they're counting two totally different things. New listings also change over time. So depending on the strategy that the listing agents are using in a given market in any given moment of time, you also have to remember that real estate agents all follow the leader. So if a leader starts a new strategy in a real estate office, all of the agents in the office will sooner or later follow that strategy. What that means is new listings are counted in a different way at each real estate board. If you take a listing and list it in September, it will count as a new listing in September. If you cancel it on September the 30th and you relist it again on October the 1st, it's counted as a brand new listing in October. If you do that consecutively over 3 or 4 months period of time, that single listing is counted in each one of those new months, each month that passes. It isn't a new listing. It's the exact same old listing, except they canceled it and brought it in as a new listing on the real estate board.
Ross, is that a common practice?
It's been a practice since about, now, I'll be honest with you here, Jim. My family is partially to blame for that procedure. Back in the early 1990s, as the housing market was correcting in Ontario, we were selling enough volume that we could do what was in the best interest of our sellers. And what was in the best interest of our sellers was to cancel their old listing. Instead of, say, we've got to reduce your price. Okay, your house isn't selling at $200,000, so the market's showing you that the neighbor's house is selling at $190,000. You've got to reduce your house to $190,000. The cheap way to do that was to do what's called a listing revision, where you did a one-page document that says, we're going to drop our price to $190,000. You kept the exact same MLS number when that happened. So a smart real estate agent like we were, we could do a search on a listing and we could find out how many times that listing had had its price reduced for our buyers. So that was one of the telltale signs you would look for. Oh, well, the K's were smart. We said, wait a second. We know that we only have to pay $5 to do a revision. And we know that if we do a new listing, it costs us $50. But we know that $50 really is in the best interest of our seller because the old listing disappears. Everybody's going to think it's a brand new listing. And because it's at a new price point, it's going to be in a new category. So many of the buyers who wouldn't even look at the listing before, now that it's been reduced in price, are going to look at it and they're going to think it's a brand new listing because it's got a brand new MLS number. So over time, over the next 10 years with computerization, you didn't have to pay $50 anymore. Now you could do a canceled and a new listing and it would cost you nothing. It was free. Because they had what they ended up doing is the MLS systems had, you pay one fee and you could have as many listings as you want. Where it used to be you had to pay for every one. So in the new environment, the weak agents who don't list any properties are forced to pay for the agents who list a whole bunch of properties. There's a reason of fairness involved there, but that's basically what's happened. So over time, all the agents started doing this. And then they forgot it for about 7 years. And then it started rolling out again in around 2016. You saw a lot of that happening in Vancouver, Jim. You saw that happening all over the place in Vancouver. It's now been happening in Toronto, and it happens at an increasing frequency. So if you're not monitoring what is an actual new listing, you can't have a new listings to sales ratio. Because you're counting old listings. They're not new listings. They're reduced listings. They're canceled listings that have come back on. They're listings that may be 6 months old that are canceled and brought back on. The house didn't sell for 6 months. It's an old listing. Your listeners need to understand, if you're buying real estate and you do not have the proper buying advice, so all of these things are explained to you, you're buying blind. You don't have the facts. The real estate, what I'm talking about here, Jim, the vast majority of real estate agents have only been in the business less than 10 years. They don't even know what I'm talking about. They just think that, oh, it's new listings. We believe the real estate board. The new listings to sales ratio. No. What happens is new listings follow sales, or in some markets, or they trail sales in another. They are a correlated ratio. They are not the cause. The sales themselves are actually the cause of the new listings. It's a reverse causation, not the one that organized real estate has tried to pull over your heads for the last 40 years. It's why real estate agents, for the first 30 years that number was created, weren't allowed to legally even use it, because the regulators wouldn't allow you to lie to the public that way. Something has happened over the last 10 years that these things are now common. So not only is it the Canadian Real Estate Association who pretends that these numbers are causational, now the local real estate boards and the realtors, all the pundits, all the housing analysts, all the experts, all the economists. What I can tell you is this: the real estate data proves there is no causation between new listings and sales. The causation is a reverse. Sales cause new listings, or sales are going to, sales always cause new listings. So in other words, I gotta watch, because I know your listeners aren't sitting here looking at what I'm talking about, Jim. And I know that we get comments after Ross is vague sometimes, or Ross, we can't really follow where he's going. These things are so black and white to me that I have a hard time at times explaining the common sense that statistics, how we describe statistics, follows. If you are going to buy a house and you currently own a house, normally you're going to list your own property. Okay? Normally that's what's going to happen. As a market slows down, we have what's called a conditional on sale, which means an existing home buyer purchases another property conditional on their own property selling. In other words, they're not going to have the financing to own two houses. They haven't sold their current house, but they want to buy yours. So you say, okay, we'll let you buy our house conditionally on the sale of yours. So if yours firms up, that means you have to buy ours. Therefore, in that instance, the sale takes place as a conditional sale and a new listing appears. That sale firms up when that new listing converts to a sold. It is a correlation, not a causation. In Vancouver, at the peak of the market, people were going out and purchasing their new home firm before their old home was even listed on the market. So there was a sale recorded, and then weeks or months later, they listed their own property so that they could move to the new one. But the market was so hot, they didn't have to worry about it selling. Maybe their house was going to go up in price over 2 months, so they didn't want to list it. They had purchased one house, let 2 months go by. Okay, now we're going to sell our old one, and we're going to capitalize on the profit our old one has made. In other words, that new listing had nothing to do with sales. It was the reverse. The sale that took place earlier caused a new listing to go on board months later, not the other way around. It's why these metrics don't work, because that ratio between when someone lists their house for sale and when they purchase their next house always is in flux. It moves up and down. We track that number precisely because it allows us to know where the market is. In your old shows, we've talked about when the Vancouver market was what we call oversold, when the Toronto market was oversold, when the Calgary market was oversold. What oversold means is people are purchasing their new house before their old one is sold. A highly dangerous and risky proposition 95% of the time. A market about 5% of the time, so 5 months over 100 months, there may be a window where you can safely do that. And that happens only for that very short period of time, and that screws up all the real estate data. It screws up all these new sales to listings ratios, which is why the real estate boards stretch the measure out to seven months. It isn't measuring last month. It's measuring the last 7, the last 6, the last 10, depending on when the real estate board who issued the number is calculating. It's why it is a correlating statistic, not a one that's noting causation.
Ross, thank you so much for updating us on so many issues.
Hey, thanks a lot, Jim, and I hope you get over that cold.
Oh, me too. My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.